A company announces losses of $1.45 billion in a single quarter. And no, we're not talking about a crypto startup that collapsed overnight or a tech company that burned through venture capital with absolutely no plan. No, we're talking about something far more interesting. The merger between Callaway Golf, a century-old brand that had spent 100 years making golf clubs and balls, and Topgolf, those massive golf entertainment venues that were supposedly revolutionizing the sport, bringing in millennials who would never set foot on a traditional golf course. In June 2021, just 3 months after completing the merger, the company's stock hit an all-time high of $37.29 per share. The combined company was worth almost $7 billion, and analysts were calling it the birth of modern golf, as if they'd just witnessed the invention of the wheel. But just 3 years later, those same shares were trading at $9.
Topgolf Callaway has plunged in share price over the last few weeks.
Sales are down 10% year over year.
The company was now worth less than what they'd paid for Topgolf alone. And when February 2025 arrived, they had to do something no CEO ever wants to do: publicly admit they were wrong.
The coronavirus could push the Eurozone into a recession.
October 27th, 2020. We're in the middle of the pandemic. Entertainment venues are operating at limited capacity, and amid all this uncertainty, Chip Brewer, CEO of Callaway Golf, announces that they're going to acquire Topgolf for $2 billion.
Topgolf is going to be providing a great growth boost to the game in the future years.
The deal was risky. Callaway would issue so many new shares that its original shareholders would go from owning 100% of the company to just 51%. The former owners of Topgolf would keep the other 49%. And on top of that, Callaway would take on over $500 million in debt that Topgolf already had. The reaction was immediate. The day after the announcement, the stock dropped 20%. The numbers didn't add up for many analysts. Callaway was a solid business that had generated hundreds of millions in profit each year. Topgolf, even in its best pre-pandemic year, made far less. So why pay $2 billion plus all that debt for a business that was much less profitable? But Brewer, Callaway's veteran CEO, had a vision. Topgolf wasn't just an entertainment venue, it was the future of golf. The way to attract millennials and Gen Z who would never go near a traditional golf course.
Positive boom for golf. We're seeing 50% more entrants to the game, new consumers.
Topgolf attracted 23 million visitors a year, and half of them had never played real golf before. The strategy was pretty simple: turn those casual visitors into Callaway equipment buyers. Management projected that by 2022, Topgolf would generate $360 million in EBITDA, 6 times more than in 2019. And at first, everything worked pretty well. March 8th, 2021, the deal finally closes, and at the right moment, everything starts to change. COVID vaccines begin rolling out nationwide, restrictions are lifted, and after being locked indoors for more than a year, people are desperate to spend money and have some fun. Golf experiences boom unlike anything seen in decades, and Topgolf is absolutely exploding. The stock starts climbing. $20, $25, $30, $35. It hits $37.29, an all-time high. Now the company is worth $6.9 billion, nearly 3 times what they paid for Topgolf just 14 months earlier. Wall Street changes its mind. The same analysts who criticize the deal are now praising it. Brewer goes from being questioned to being celebrated as a visionary. In September 2022, they even changed the company's name from Callaway Golf Company to Topgolf Callaway Brands Corp. They put Topgolf first, a clear signal of where the future was heading. And the numbers seem to back it up. The company was generating billions in revenue each year. Topgolf already represented nearly half of the entire business and was still growing aggressively. Everything looked perfect. But one small number hidden in the earnings reports was about to reveal that all of this was about to collapse.
So I'm here at Topgolf in San Antonio, and believe it or not, despite the parking lot here being pretty busy, this place is in trouble.
Q4 2023. While management was celebrating another successful year and announcing the opening of 11 new venues, one number in the earnings report quietly flipped from positive to negative for the first time. Same venue sales dropped 3%. If you don't know what same venue sales means, let me explain why it's the most important metric in any retail or venue-based business. Same venue sales measure the revenue from locations that have been open for more than 24 months. It's how you tell if your business is actually growing or just hiding deeper problems by opening new locations. And that number had just turned negative. Management brushed it off. It's cyclical, they said. Just a temporary dip. They'd bounce back soon. They were wrong about everything. 2024 was like watching a train derail in slow motion. That same venue sales number that fell 3% in 2023 didn't recover. It got worse every single quarter. Fewer and fewer people were visiting existing Topgolf venues, and that's the core problem. When people stop going to your current locations, it doesn't matter how many new ones you open, your business is dying from the inside out. But the real collapse came from somewhere else. Corporate bookings disappeared. Think about it. Corporate events were the crown jewel of the business. Companies booking multiple bays for team building, end-of-year celebrations, or sales events. Those weekday reservations filled venues and brought in premium, high-margin revenue. And that business collapsed. Companies simply stopped spending on those kinds of events. Even the CEO admitted it on an earnings call.
With same venue sales down mid-single digits for the full year and 10 to 13% in Q1.
Profits plummeted, but management kept opening new venues as if nothing was happening. 11 new ones in 2023, as if adding more locations could fix the fact that no one wanted to go to the ones they already had. Then came another problem: debt. When Callaway bought Topgolf in 2021, interest rates were near zero. Borrowing money was basically free. But then the Fed started aggressively raising rates to fight inflation, and didn't stop for 2 years. The problem? Topgolf Callaway had billions in variable rate debt. When the Fed raised rates, their interest payments automatically went up. Their interest expenses doubled. Suddenly, they were spending hundreds of millions of dollars a year just paying interest. They were trapped. Banks wouldn't refinance under better terms. They couldn't pay off the debt quickly because they needed that cash just to keep the venues running. And while all this was happening, consumer behavior changed. The post-COVID spending boom was over. Inflation hit family budgets hard. People started cutting back. And when you have to decide what to cut from your monthly spending, a night out at Topgolf, costing $50 plus per person, is one of the first things to go.
It is more expensive to go play golf for an hour at Topgolf than 90% of golf courses, public golf courses.
Management realized the problem too late and tried every desperate tactic they could think of. Free game promotions, Sunday discounts, weekday specials, even a partnership with Sonic the Hedgehog to attract families. None of it worked. People simply stopped showing up. And by September 2024, they had to do something no company ever wants to do just 3 years after a massive merger. September 4th, 2024. 3.5 years after what they once called a transformational merger, the board of directors announces that the company will split back into 2 independent businesses. The press release was filled with elegant corporate language, phrases like enhanced strategic focus, streamlined operating structure, and maximizing shareholder value. But everyone knew what it really meant. CEO Chip Brewer said it in the most diplomatic way possible.
On the strategic front, we are productively working towards the separation of Topgolf, evaluating both a spin in the second half of this year and a potential sale.
Translation: the merger didn't work. We were wrong. And there was evidence of that everywhere, by the way. The integration they promised never actually happened. Even 2 years after the merger, in the 2023 annual report, the company was still saying it would make efforts to sell Callaway equipment in Topgolf venues. That basically admitted it still hadn't happened yet. The whole grand plan of turning Topgolf visitors into Callaway club buyers never materialized. But the most brutal admission came months later. February 24th, 2025, earnings day for Q4 results. And buried in the middle of all the financial numbers was one line that said it all. $1.452 billion in intangible asset impairment charges. $1.45 billion. Let me explain what that means in plain English. It's the company officially admitting that Topgolf is worth $1.45 billion less than what they thought when they bought it. It's basically saying we were wrong by $1.5 billion. The final results for 2024 were devastating. A net loss of nearly $1.5 billion, shares that once hit $37 were now trading between $9 and $10, and the entire company, not just Topgolf, was worth $1.5 billion. That's less than what they paid for Topgolf alone 4 years earlier. And the projections for 2025 showed no signs of recovery. Management forecasted declining revenue and continuing drops in same-value sales. They finally admitted publicly what was already obvious. This wasn't a temporary issue, it was structural. The business was fundamentally broken. But the story still wasn't done getting worse. July 2025, Topgolf CEO Artie Starrs suddenly resigns to take another job. The planned separation, originally scheduled for late 2025, is now delayed until 2026, and the company announces that the spin-off will cost tens of millions of additional dollars. They were literally paying a fortune to undo the deal that had cost them billions to make.
I'd like to thank all of our employees and partners for their outstanding work year to date in driving our better-than-expected performance in what is an uncertain and challenging operating environment.
So what went so wrong? Basically, they bought at the worst possible time. During the pandemic, everyone was desperate to go out and spend money. Topgolf was booming. Management looked at those numbers and thought, this is a new normal. They paid $2 billion believing that post-COVID demand would last forever, and it didn't. It was temporary. And there was another massive issue. When they closed the deal, interest rates were at zero. They had billions in debt, but it didn't matter because that debt was pretty much free. Then the Fed started raising rates aggressively, and suddenly that debt became incredibly expensive. Meanwhile, they kept opening new Topgolf locations as if nothing was wrong, even as existing venues were losing customers. They tried to grow their way out of the problem instead of fixing it. And the integration they promised, that brilliant plan to convert casual Topgolf visitors into Callaway equipment buyers, never happened. The irony is, Topgolf as a concept actually works. People still enjoy the experience. The problem was disastrous timing and overpaying for something at the height of artificial demand. Today, the stock trades at $9. The entire company is worth the $2 billion they paid just for Topgolf, and they completely destroyed Callaway's value. And, well, I won't drag out this video any longer. If you enjoyed it, make sure to subscribe. I've got plenty more stories like this on the channel. Thanks for watching, and see you in the next one.